The RBA is set for a massive change. This follows a review conducted at the request of Treasurer Jim Chalmers, and he has approved the recommendations. Now this of course is something of interest and of great importance to anyone who owns a property or who is looking to buy a property, because after all, the RBA controls interest rates, and the RBA is therefore going to influence how expensive that property ownership experience or property purchase is going to be. So let's have a look at some of the major changes and whether or not these are likely to be beneficial. So what then are the changes to the RBA? Well, the review into the RBA came up with 51 recommendations, on which the Treasurer Jim Chalmers is going to act. Now the details surrounding these still need to be ironed out, and many of these changes will require legislation, but we can see at a high level what is likely to be altered. The first major change is that how interest rates are set is going to change significantly. Heretofore, the RBA has just had one board that would meet 11 times per year to decide on whether or not to change interest rates. However, that is now going to change. It will be split into two boards. You'll get a governance board in charge of overseeing the day-to-day operations and the like of the RBA, and you'll get a monetary policy board. The monetary policy board will be in charge of deciding what the interest rates are going to be. The monetary policy board would have the RBA governor, the deputy governor, and the Treasury secretary. It would also have external members that would be decided upon by the treasurer. These would, in theory, be decided upon via a transparent process. However, how transparent that ultimately becomes remains to be seen, and exactly how expert those people need to be and where the area of expertise lies, again, that remains to be seen. So there is quite a lot of opacity there that could ultimately become a bit of a problem. And you can easily see that political wrangling and political interference could influence how the RBA ultimately operates. However, that is going to be one of the major changes. The second major change is there's going to be a little bit of an alteration to the RBA's mandate. Now, the major recommendation, which seems set to be acted upon, states the federal government should legislate that the RBA has a dual monetary policy objective of price stability and full employment, with an overarching purpose of providing economic prosperity and welfare for Australians. Now, that sounds all well and good. However, it does have a little bit of an issue underlying it. The RBA heretofore has been primarily focused on inflation. Now that is actually a good thing, because getting inflation under control is overwhelmingly good for everyone. It's overwhelmingly good because the higher inflation is, the more your income after having spent things will go down. That is, when the cost of goods keeps going up and up and up, well then your net income after inflation keeps going down and down and down, because everything is getting more and more expensive. So therefore getting inflation under control is inherently good. Furthermore, if inflation starts spiraling out of control, well, businesses are now going to have to spend more for their inputs, the various things that they need to use to go and sell you things. And therefore, they're going to employ fewer people because they're spending more on goods and they can afford to spend less on individuals, which ultimately harms employment. In essence, if you let inflation get out of control, that is bad for employment. So making sure inflation remains within target is actually going to be inherently good for both economic prosperity and for employment. However, it appears that in this recommendation, there's now going to be a little bit of a shift in focus toward not necessarily tackling inflation immediately, not tackling it as quite as aggressively, not increasing interest rates quite as much in order to get inflation back down to target quite as aggressively. Rather, there's now a bit more of a focus on employment. Now, and ultimately whether this makes a difference remains to be seen. After all, if the RBA keeps doing its job, well then targeting inflation back down toward where it should be, that target range, is ultimately going to be consistent with and support the job's objective. However, exactly how they operationalize this remains to be seen. The third major recommendation I want to go over is what is not recommended. And this particularly relates to climate-related factors. Now, in the United States, there has been a little bit of a push to get the Federal Reserve to more actively consider climate change and the like. In the recommendations, they really shied away from this, and there were two major recommendations that really came up here. The first one is the RBA should take account of climate risks, but not use monetary policy to address them. In essence, here it's saying the RBA should consider climate risks when engaging in economic modelling. That makes a lot of sense. After all, if climate risks start to undermine the economy, start to undermine economic growth, or start to harm inflation, or potentially start to harm employment or the like, well, in that case, you need to consider those when you're doing any of your economic modelling. In essence, this is basically just saying the RBA should consider climate-related factors as one input into their general economic modelling, which they should be doing anyway. The second major recommendation is the federal government should not make a transition to a low-carbon economy an explicit objective of the RBA's monetary policy. Instead, it is the government's responsibility to set the mix of policies to pursue and manage the transition. Here, the recommendation explicitly says the RBA should not be basing its decisions on what is happening with climate change and the like. Now, this is inherently sensible and really should go without saying. After all, the RBA shouldn't be going around trying to use interest rates as a very blunt object to try to get on top of climate change. Interest rates really affect the cost of capital, which obviously is going to affect how much it costs you to go out and invest in climate-related technologies. However, it affects everything in the economy. So interest rates are an extremely blunt tool with which to tackle climate change. So that recommendation makes a lot of sense. That is, it makes a lot of sense to not have the RBA trying to tackle climate change, because that's something that really rests within the government policy. The next question is whether these changes are good or bad, either for the economy or for homeowners or prospective buyers or people in general. Now here we've got something of a mixed outcome. Some of these recommendations make a lot of sense. After all, the RBA should not be involved in climate policy related matters because this is really a policy decision rather than an interest rate related decision. And as I've indicated, it makes no sense to have interest rates used as a tool to try to set climate policy. Furthermore, there isn't an inherent problem with having jobs and inflation being dual mandates here. After all, getting inflation down to a target is inherently good for job creation and economic prosperity over the long term. But of course, if you've got people making short-term political decisions without a real knowledge of how interest rates affect things, then they could easily perceive interest rates and hiking interest rates as bad for jobs without considering the long-term implications of them. And this then leads me to the problems with this Monetary Policy Board. Now, the Monetary Policy Board will comprise of outside experts. Exactly what is an expert remains to be seen. How transparent the process is remains to be seen. How the Treasurer makes decisions, again, remains to be seen. Whether there can be any review of this, again, remains to be seen. After all, the Treasurer might just appoint people that are political allies of that Treasurer. He or she might just decide to appoint someone from his or her side of politics, or aligned with his or her political objectives. If, for example, it's an ALP Treasurer, then maybe that ALP Treasurer has an incentive to appoint a unionist to the RBA's Monetary Board, even though those unionists might not have any idea whatsoever about monetary policy or economics or finance. That is, you might end up with non-experts that have some other political motive being appointed to the board, and that's ultimately going to be bad news. That is, the Treasurer might just appoint people for political reasons. Another area this might occur is the Treasurer might want low interest rates because that might make him or her look good come an election time. And therefore the Treasurer might try to appoint people that will pursue low interest rates. And this therefore could create problems ultimately to long-term inflation and long-term economic prosperity. Political interference with the central bank tends to end extremely badly and is something that needs to be avoided. We also have the concern that you can almost find an expert to say whatever it is that you want. There are experts that routinely disagree with one another, and that's inherently good. However, it does mean that the Treasurer could just pick an expert that will support his or her view. So say, for example, we take academics, for example. Well, financial economists typically disagree all the time with macroeconomists. Financial economists tend to believe in individual autonomy, individual liberty, and tend to believe in incentivizing people to go out and create more wealth and keep more of their own capital, keep more of their own property, rather than it being controlled by the state. By contrast, macroeconomists, at least academic macroeconomists, they tend to favor government intervention. They tend to favor the government controlling what people do in the economy and controlling more and more what's going on with property. They tend to believe in more central planning, that is. So you end up with this inherent disagreement between two different types of academics. And this therefore means that the Treasurer could supposedly appoint an academic expert, someone that might look good on paper, even though it really is ultimately a political decision, which is something that could ultimately end up being a problem. So overall, these changes to the RBA aren't necessarily good. There's a lot of risk associated with them, and the Macro Policy Board, the Macroeconomics Board, could easily end up with political issues dominating it that might make it actually much worse than what we currently have. But otherwise, let me know your thoughts in the comments below, and otherwise, thanks a lot for tuning in. Don't forget to subscribe, and hopefully I see you next time as well.